Good afternoon, good morning, good evening, everyone. Welcome to Diary of a Trader, and today's video is going to be over trailing stops. Now, when you're new to trading in general, there's a lot of different terminology that you learn from pip to open, close, bid, ask, offer, limit, stop, a market, and there's a whole bunch of lingo that goes into learning anything. It's like learning any type of trade. You have to get used to the verbiage that you're using. And one of the things that we learn about is trailing stops. And if you're unfamiliar with them, my hope is to introduce them to you. And I use them frequently in my own trading. Trailing stops are a huge part of how I trade, and I think they should be something that everybody uses in their trading. So real quick, what is a trailing stop? Okay. A normal stop is something like this. So if I want to open up let's go to I never trade on this time frame, but let's go to like a 5-minute chart, and let's look at the euro dollar. So let's say I wanted to go long. I'm just going to do like a market long of a full lot of the euro dollar, and I'm going to put my profit target up about 10 pips. Okay, but if I want to set a stop, how I would usually set a stop is you would set it a certain amount of pips. So let's say I want my stop to be 10 pips away. Okay, and that would populate on the screen, and you can see there's my entry, there's my take profit, here's my stop loss. Okay, so the stop loss, for review, is just if price gets down to that stop loss, which is at 111.01. If price gets down there, then I exit the trade. Okay, it automatically exits. The problem with that is twofold. One, if price does move up, okay, let's say price moves up about 5 pips on a 5-minute chart. All right, if I'm not looking at my screen, if I'm not paying attention to it, and price moves lower, I could miss out on some potential profit. I would miss out on part of that position. I can protect my profit by moving my stop up manually, but maybe you don't want to do that. Maybe you don't have time to adjust it manually. So maybe you like to hold positions overnight, and everybody has to sleep. One of the ways that you can kind of provide a little bit more insurance on that trade is using a trailing stop, which is something it's the next best thing to manually setting your stop and adjusting your profit. Okay, it's the next best thing to that. So let's look at a different trade here. I'm just going to close out of that. Let's look at the pound yen. That one's always very active. So let's say I want to take a short here. I'm going to do that right now. I'm going to take a short there. I'm going to put my stop at 10 pips. Oops, that's not it. I wanted needed to sell. There we go. Silly mistakes. So if I want to sell that there, I'm just going to hit sell. There's my stop. Stop's going to be up here. So I've shorted this. Now, instead of moving this stop loss manually all the time, what I can do is I can convert it, or I could set it up differently. So I can modify my stop here to be a trailing stop, okay? And so what a trailing stop is, what it's going to do is if price moves down below my entry at 1 pip, the stop moves down 1 pip as well. It will automatically drop and move in tandem with price as it moves. So I don't have to do it manually. It does it automatically. Let's go over to like a 1-minute chart. I don't think we'll get to see this trade lower, but if it does while we're looking at it, we'll be able to see it do that. Trailing stops are useful for people who have, if you do hold long positions, like I hold. You just saw it drop down. See it dropping right there. That's what I was looking for. I was hoping it would show up for the video. But you can see as price moves lower from the entry where the stop was set, excuse me, you will see the trailing stop drop down as well. It doesn't pop back up if it starts to retrace. it just keeps going down. So that way, you don't have to constantly sit at your monitor or your station. It will automatically adjust to capturing some profit or further reducing the initial risk that you have. Okay, trailing stops are a phenomenal piece of work. Now there is an inherent danger to them in that a trailing stop can be inefficient on faster time frames. Okay, I'm looking at a 1 minute chart. I never trade on a 1 minute chart. Fastest time frames I typically trade on is probably like an hourly chart. But if you're trading something on a fast time frame like this, you're probably already active. You're probably not leaving a long position, like long time ways. You're probably not walking away from your trade station for a few hours on a 1 minute chart. You're probably actively managing that position. But anybody trading on something underneath an hourly time frame, depending on the day and the pair, you may not want to use a trailing stop just because there are some pretty wide variances in price. There are some whipsaws that occur, and you could run the risk of missing out and getting whipsawed out of a trade with a trailing stop. That risk is normal in any type of fast time frame with even a normal stop. But as you would use trailing stops, you're going to realize that they will get hit at times you don't want them to. So there is kind of a rule of thumb with trailing stops that you would want to probably set them depending on your risk. I personally do not set my trailing stops at the same level I would put a normal stop. If my normal stop is 100 pips, which is roughly depending on the Forex pair, it's around 100 pips. For something like the pound Aussie, it's around 160 pips. But if I was doing a trailing stop, I would increase that stop by about 50%. All right, because I know that if I'm sleeping or if I'm running an errand, I know that the trailing stop, if price is moving in the favored direction, it's going to keep ticking along with price. And I know from experience that once your trailing stop gets to your entry zone, that's often the point when price wants to retrace to test that entry. And instead of staying in the position, you will have gotten stopped out of it, and just to see price continue in the direction you wanted it to. So trailing stops should be used on longer time frames, and you should provide them a wide berth. Some people ask questions like, if you're going to go to sleep, or if you're going to run an errand, why not use just a regular stop? The reason is because if something starts to move into profit, or even if it doesn't move all the way into profit, I want to make sure that the risk I have on the table is either going to break even or capture a little bit of profit, or that the risk is reduced as price is moving up. If I have just a regular stop sitting there, I've already determined that money's going to be lost, but a trailing stop allows me to better manage and adjust as needed, and provides a lot more semi-active management of the trade. You'll find trailing stops very useful in trending markets. All right, if something's in a trend, trailing stops are awesome. In ranging markets, they are not. I would not. And again, in Forex, what is considered a trend is and a range is dependent on the time frame you are trading. But if you're trading something and it's in a range, I would not use a trailing stop. All right, you're going to get whipsawed out of more trades than you're going to get into profit using a trailing stop. So something that's in a trend on a long-term or even a short-term time frame, trailing stops are excellent. They're excellent to use in trends. In a ranging market, don't use them. Well, I hope you found this video helpful and interesting, and I look forward to speaking with you in our future videos. Bye-bye.